Hey guys, Kolomeyer here, and today we're going to be taking a look at put options. If you haven't watched my previous video on call options, then I recommend you watch that first. But if you have, then if you watch this video and you end up enjoying, then make sure to drop a like button for the YouTube algorithm, subscribe for more content like this, and with that out of the way, let's get right into it. Like call options, put options are also an agreement between a buyer and a seller. Another similarity is that like calls, this buyer pays a premium to the seller of the option for the option to fulfill the option. The main difference between a call option and a put option is that a call option is an agreement for the buyer of the option to be able to buy 100 shares of the underlying stock at the strike price on the expiration date, while the put option is an agreement that allows the buyer of the put option to sell 100 shares of the underlying stock on the expiration date. So in this regard, a put is basically the opposite of a call, and if you're feeling a little overwhelmed with this, we're gonna explore some examples right now. So if you're bearish on a company, as we previously discussed, you can sell a call on that company, or another opportunity is that you could buy a put. By buying a put, you're ensuring that you can sell 100 shares of this underlying stock to the seller of the option at the strike price. Let's say that you bought a put of Kolomeyer Incorporated, which is currently trading at $100 a share. The put's strike price is $100, and the put would cost you $1 per share, or $100 total. Keep in mind, this is a made-up number, not a specific number. Also, in this example, the put would expire in a week. This is important to keep in mind since time impacts the value of an option. So let's say you were correct in your assumption that Kolomeyer Incorporated was going to decrease. By the end of the week, Kolomeyer Incorporated decreased to $95 a share. If this happens, then you can go to the market and buy 100 shares of Kolomeyer Incorporated for $95 a share and then sell it to the seller of the put for $100 a share. This means that you made a $500 profit, but because you had to pay $100 to open the contract, you only made a $400 profit. Nonetheless, this is a huge profit. On the other hand, you would sell a put if you're slightly bullish or if you're neutral on a company. You would receive $100 in credit for selling that put, and as long as the company remained over $100 in value, then the put would expire worthless because the option buyer could sell 100 shares of the underlying company to the market instead of to you and receive a greater sum of money. However, even if the underlying stock were to go to $99 a share, because you received $1 per share for opening that trade, as long as it remained above $99 a share, you would remain profitable. For the above examples, I described the optimal scenarios for both sides. Now let's look at what happens if the trade goes against. For buying a put, the max loss is the amount that you paid in premium. Meanwhile, your max gain is the strike price times 100. For selling a put, the max loss is the strike price times 100, and the max profit is the amount that you received in premium. This is technically, of course, and doesn't often happen in real situations, because technically, the stock could go down to $0 a share, and you would be obliged to buy 100 shares at the predetermined strike price. In this situation, you lose the entire strike price times 100 of the stock. Now let's look at a real example involving puts. For this example, we'll be taking a look at Bank of America, and BAC is trading at $24.50 a share. The $24 put expiring July 17th is currently trading for 57 cents a share, or $57 total. This means that if you're buying the put, then you would only become profitable if Bank of America decreased past $23.43. Meanwhile, if you are selling that put, then you remain profitable as long as Bank of America remains above $23.43. Hopefully, after watching the last two episodes of Options 101, you'll have a basic understanding of what call and put options are. The next couple of episodes will go over crucial information that you need to understand about options prior to trading them. And then once we go over that information, we'll get into more complex option strategies. Of course, we're going to start with more simple strategies, but we'll work our way up to the most complex strategies, such as iron condors. With all that being said, if you enjoyed today's video, then make sure to drop a like for the YouTube algorithm, subscribe for more content like this, and with all that said, I'll see you next time. Till next time.